halfway through the cycle. Halfway through the cycle. But watch out for over extremes of optimism and pessimism. There are tulip manias. I mean, it's hard to believe that people bought tulips and paid money for them. And today, I must tell you that assets in general in the world, if I told you, I own this stock, it's a particular biotechnology stock, it's been a very good investment, the name is irrelevant. It has to be called ILX Technology, but it's irrelevant. It sells for $1 billion in the marketplace. No one in his right mind would hand over $1 billion to buy the whole company. And that's true. How many of you think you could get a return on most of the stocks where they're selling today if you had to rely on the flow of cash back into your pocket to pay you a rate of return? So assets are not cheap in the historical sense. There was a time when people said stocks had to yield 4%. If I had to guess, I would guess that time will occur again. We're probably between 5 and 8 years away from that kind of a scenario. But it's just when you believe that you're in this new era and that you can never have a reactionary period. It may come from 15,000 to 13,000 to 14,000. Remember that dividends at some point in time do count. And also there's another point to remember. Walmart versus Gateway, Kmart, Kresge, long list, Transitron. I didn't take you through the historical perspectives of all the declines that have occurred along the way. The 87 crash, the 2 crashes in 61, 62, the 82 crashes in the stock market, and crashes are a strong word. They're all lost. But you know, Gateway is literally almost going out of business. And Kmart went out of business, and Walmart gets big. So within the sectors and the industries and the companies, there will be successes and failures. Many of us attended, many of us attended a YPO function down in Miami Beach. And they had a very big fancy trust company there. And actually one of the trust companies I have is one of my trust companies. And they're really, really very good, and I won't name them. Those of you who know. And they had this kid come in, and the kid was saying, they actually had him up here talking about you had to put your money into his technology fund. He was up 500%. Made absolutely no sense that this particular staid, conservative investment trustee had come in all of a sudden pushing things that were selling at 900 times sales. By the way, Blodgett was right. Blodgett was not wrong. The internet is only in its infancy. It hasn't even begun. Conceptually, he was right. When George Barber built Woodfield Country Club and went bankrupt, his timing was wrong. But Woodfield turned out to be an enormous success for the next guy. His timing was wrong. So timing is an important matter if you try it, but I wouldn't suggest that most of you do deal with the history. Now, when I graduated from college, we had a textbook called Graham and Dodd. I'll go quickly now. Graham and Dodd. You had to study balance sheets. If you went into any balance sheets and annual reports and depreciation and cash flow, if you went into any portfolio manager at any major institution in this country, and you asked him, when's the last time he looked at the balance sheet of one of the companies that he has in his portfolio? Whoa, let me reach in my drawer and get it. But then you tell me how much cash they have. Tell me what their accounts receivable are. Tell me what their debt ratio is. They wouldn't have the slightest idea, and I'm talking about the biggest money managers in America. There are still some isolated people. That's not how the stock market works today. The stock market works in terms of trend, direction, sectors, big decision, industries, and those few companies that are going to succeed. Graham and Dodd is a fine thing for accountants, but it's unrealistic in today's world, no matter what Warren Buffett says. By the way, they took this is important, they took all of the speeches made on Louis Rookhouse's program. Am I boring you at this point? Sure. They took all of the speeches. Okay. And they correlated everybody's opinions. They had a negative return for 15 years. Negative return for 15 years. You know, research is valuable, but you have to know how to use it. But you know, the same people who work as analysts today at Merrill Lynch, or at Bernstein, or anywhere, they're not the same people at 10 years ago. Because no one can do it. You think some kids can come in, go visit a company if they're lucky, sit down with some manager and say, Mr. Manager, answer me all these questions about what you plan and what you do and where you're going? Then they go home, they write a report, it's a great meeting, and look at all of this stuff and have prediction after prediction turn out to be right? It's absolutely impossible. The companies can't do it. If the companies can do it, Gateway wouldn't be out of business, U.S. Steel wouldn't have gotten in trouble, Caterpillar wouldn't have gone down the drain for years and years, etc., etc., etc. It's a huge random system, which we're all trying to be the winners and have more bathrooms. Because the ones that win get the bathrooms, the key, the extra bathroom, the bigger house, the more food, the better education, the more milk for your baby in Africa, the more drugs. The whole world is based on an attempt to increase the standard of living. And that's the value of America. Last time you saw the record of a portfolio manager? Never. The performance of brokerage mutual funds? How could it be that they would want to produce records that were less than the market? Fact is, they just can't do any better. Hedge funds? I'll tell you about hedge funds. There is no such thing. When I came into the business, I'm an old guy now. I'm going to be 70 in a few years. The smartest people, A.W. Jones, Michael Steinhardt, Jim Harpel, Michael Berkowitz, these guys are all geniuses. That's who ran hedge funds. As the years progressed, hedge funds, great business. You get 20%, you charge a 1% fee, you make a few opinions, you get it right. Man, people pour their money in, okay, you collect your money, you're rich, you close down. You didn't do well the next year, you got $20 million or $200 million. And it's in a short period of time. So when you get 20% of profits, you just take a few guesses, you get it right, that's just great. But that has nothing to do with investing your money between the age of 25 and 80. It's a great business for the manager who happened to get it right. Today, the hedge fund businesses, a lot of them are failing and are filled with people who don't know the business and are just gamblers, and you shouldn't give them your money. Magellan. Think about Magellan. Just think about this. And maybe there's nothing more important than this. The flagship fund of Fidelity, fantastic company, cannot perform Vanguard. How could that be? Only because the nature of the market is such that it's impossible. No matter what. Now, where does the value of money management come in before we get to Elliott Spitzer? The value of money management comes in the Elliott Spitzer. If you ask me, fees and mutual funds, they became so big, should have been reduced. Just on the basis of size alone. But the average amount of money, it wasn't as if one customer was buying more shares, it just got a lot more customers with $100,000 or $200,000 or $50 or whatever. So you could argue either way, but by reducing the fees, you also reduce the personnel. You reduce the quality of the personnel. You reduce the amount of money available to try to perform well. And you again interfere in the free process. The government's interference in the savings and loan process cost this country tens and tens and tens of, how is it Charlie said, we go through it, we know. They did everything wrong. They did it all completely wrong. All they had to do was leave it alone. But they didn't, and they interfered because the people got scared and it was all completely wrong. But the issue by Spitzer is being completely missed because it's not the fees. Yes, these funds did something illegal, they should go to jail or whatever it is that their crime is that they did. And that's a separate issue, and that should be taken care of, there's no question about that. But if you didn't have these collective funds to manage people's money, you know where you'd be? At your brokers. And if you ever went into a brokerage office and found the manager in a brokerage office, and I don't mean to be negative on everyone because everyone's trying to make a living, but the facts are the facts are the facts. And you said to Mr. Manager, show me the performance of the clients of this office. He show you the commission run of who's his biggest commission producer. But he won't show you the performance of the clients because he doesn't have it. So the choice that the customer would face would cost them substantially more money